Thank you for joining us for the tax planning in an uncertain environment session today. My name is Jenny Kramer. I'm a tax partner at Sikich with 15 years of experience working with businesses and their owners to utilize tax planning and knowledge of the current and potentially changing tax rules and regulations to help enhance your business decisions. I'm here today with my colleague Drew, who I'll let introduce himself.
Sure. Good morning, everybody. Like Jenny said, and like you see on the screen, my name is Drew Long. Do many of the same things Jenny does. We work together closely in our firm, and we enjoy what we do. And we're just looking forward to sharing some thoughts and ideas with you.
Yes, thank you. What we hope to accomplish today is to highlight certain aspects of the current and recently issued rules and regulations to keep top of mind over the next few months here as 2020 comes to a close. We do encourage you to submit questions via the chat function available to you in your control panel, so please look for that. Thank you to those who did submit questions in advance as well. We can tell that the PPP loan is still very top of mind for many, as we received many questions related to applying for PPP loan forgiveness as that draws near. The focus of our topics today are a little bit more income tax planning focused. So if we do not answer your specific questions, please note that the Sikich PPP team will be releasing more material around the PPP loan and forgiveness topics. So please watch for that and reach out directly, and we'll be happy to put you in touch with our experts on that topic as well. But we'll try to cover everything you've asked or anything that you comes to mind during our conversation today. You can also access these presentation slides in the control panel. Note that we'll be launching polling questions throughout the presentation, so we certainly encourage you to participate by answering those questions. And for those of you who are participating for CPE today, please be sure to answer those questions, as well as respond to a short survey at the end of the webinar. So I think that covers the housekeeping items and logistics, but again, please bring up questions as we go if you have any. Otherwise, I think you're going to find this session to be hopefully a little bit more of a conversation between Drew and myself, just like we'd envision a lot of the conversations that you and your advisors are having or should be having between now and the end of the year. This year, by far, is really no one size fits all or even most scenario for your critical planning and discussions that you're going to be having towards the end of the year here. We have a lot of things that have happened already this year and a continually in changing environment, as we'll talk about. So how to best apply those opportunities to your specific set of facts and circumstances is going to be a very important discussion that you have throughout the remainder of the year. Okay. So with that, I'm going to let Drew go ahead and walk through our agenda for us.
Sure. Yeah. As you can see, it's a pretty simple agenda. We're gonna get into some details of the CARES Act and some second chances that we can take advantage of here before 2020. And then after that point, we're really just going to get into some planning ideas, and we're going to go over some things that we're thinking about, and then and just to kind of tie a bow on the year and just see how we can move forward and make sure we take advantage of everything that's out there for us to take advantage of. And just one more thing before we dive in, just got to say it, it's been an interesting year for everybody. And anytime we talk about tax policy, just know that we're not opining on any political opinion. We're just trying to make the most of the current business environment that we have. And so with that being said, Jenny, I think let's get started.
Yep, we're gonna come back with our webcams towards the end, but we're gonna let you have the full screen for your slides and notes. And so we will continue from here.
Okay, see you guys soon.
Okay. All right, so we're gonna, as mentioned, we're gonna start with a recap of some of the important tax provisions that were part of the CARES Act that we want to ensure that you're keeping in mind and have already taken advantage of, or hopefully are incorporating into that year-end planning. So we'll start with a relatively simple one. We're going to start easy, and this goes all the way back to the recovery rebate credit issued as part of the CARES Act. So you might recall this was the advance credit of $1,200 or $2,400 for joint filers, plus $500 per qualifying child. And there are phase-out limits for that at adjusted gross incomes of $150 for joint filers. So many of you might think what's done is done, and either you received that advance payment or you didn't qualify, but you do have a second chance. So the advance credit was issued during 2019 based on whatever tax return the IRS had on file for you at the time, either your 2018 or 2019 tax return. However, when you file your 2020 tax return coming up here in 2021, there will be a reconciliation of the credit qualifications based on your 2020 actual income and dependents. The nice thing is the IRS will not make you pay back excess credit paid to you previously. So what you've received isn't going to get clawed back at all. However, there are opportunities to receive more. So that's just a few quick items here, reminders of things you could be looking at to make sure you maximize the receipt of that credit. So maybe you had an additional qualifying child in 2020 that would result in an additional $500. Maybe someone is no longer your dependent in 2020 and therefore would now qualify for their own $1,200 credit. This might be particularly applied to maybe some college age students or those, just kind of transitioning from college to the workforce who are now supporting themselves. But keep in mind that parents wanted to carefully consider this with potential education credits or head of household status claims as well. But the items you probably have a little bit more control over for 2020 is your income, right? Do you fit under that threshold? So if your income was above the thresholds that allowed you to receive the maximum credit in 19, possibly take a look at slipping below that threshold in 2020 and qualifying. A few items that you could look at if you're close to that threshold would be maximizing your traditional 401k or IRA contributions to lower your income. Or if you're at the age where you're actually taking 401k or IRA distributions, possibly lower or forgo those for 2020 since there is no required minimum distribution amount this year. So just a few simple thoughts to look at if you're close to that threshold. And one final item on that topic is that, while you have some reconciling item to do related to the credit on your 2020 tax return, note that that recovery rebate credit will not be includable in gross income in 2020. So just a quick item that I know is long past us, but a little reminder that doesn't hurt. All right, so let's dive next into a few items, again, from that CARES Act that were pretty significant and are going to play out here in many of the items we talk on. First was the Qualified Improvement Property Technical Correction. And just as a reminder, that was when the Tax Cuts and Jobs Act was written. There was basically a typo that resulted in the Qualified Improvement Property category to be depreciable over 39 years and not be eligible for bonus depreciation. However, it took congressional action to correct the law, and this correction was finally included in the CARES Act. So as a result, retroactive to 1/1/2018, qualified improvement property does now have a depreciable life of 15 years, and more importantly, qualifies for that 100% bonus depreciation expensing in year one. So technically, you do need to correct this at some point, as you're now basically using an improper tax life or method if you put something in a qualified improvement property in service at 39 years.
Hey, Jenny.
Yeah.
Qualified improvement property, I know many of us have kind of grown up with the leasehold improvement rules that were in place through 2017. Does this property have to be subject to the terms of a lease in order to be qualified as a qualified improvement property?
Right, good question, Drew. No, that was, a lot of those categories of property that were before the Tax Cuts and Jobs Act, where your qualified leasehold improvements, qualified restaurant property, and in the Tax Cuts and Jobs Act, those all kind of got lumped into this qualified improvement property category, which, one nice thing is it is no longer subject to the terms of a lease. And there used to be, I think, a three, requirement that you hold the property for 3 years before doing any of these improvement items, and that's no longer the case either. That restriction was removed with the Tax Cuts and Jobs Act, and you can basically purchase a building and immediately renovate it with those qualified improvement property renovations, and they would be eligible for this bonus depreciation 15-year tax life class.
Great. So then when the building's in service, then you can start thinking about this.
Correct.
Okay. Thank you.
Yep, no, good questions. And just a quick sidebar on, what again is that qualified improvement property. It's really going to be those tenant improvement build outs, redoing interior office space. Think of redoing the interior of a restaurant, think installing or replacing drywall, ceilings, interior doors, interior lights, any of those interior components. What's not going to qualify is, if you're actually enlarging the building, elevators or escalators, or things that are part of the internal structural framework, something that's going to be a load-bearing wall or a staircase, things of that nature. So you do really want to take a look at what's involved in that renovation, if that's what's been done, to make sure you're carving out the appropriate qualified improvement property that qualifies for this.
And Jen, I know that most of us aren't engineers or contractors, so at least us accountants aren't. How do we tell what a structural component is? Do we get a cost seg study done? Is that usually what happens?
Right, that's always something good to consider. So cost segregation study is where you bring in, a professional engineer is going to really carve out those items and provide a supportable report, that can be defendable with the IRS, and make sure you're carving out those pieces appropriately. So that can be really valuable and important to not only identify the non-qualified improvement properties, such as the structural components and the exterior work, but it could also be important to separate kind of some of the more personal property items too that could be depreciated over even shorter lives, which could be beneficial for state income tax purposes in states that don't conform to bonus depreciation. So cost segregation study is always something good to evaluate, and we can always evaluate that opportunity and see if it makes sense. So want to move on to really what are the opportunities here, and how do we correct if you've had a piece of qualified improvement property placed in service in 2018 or 2019, what are your options? Because you should do a correction to that. So here in this example, say you put qualified improvement property in service in 2019, got your tax return filed before the CARES Act came out, and you're basically receiving a $6,000 deduction in 2019 from that depreciation because it was spread over 39 years. However, you basically now actually have a decision to make. So you can either, you do want to address and update the incorrect tax life and method, but you can do that by either going back and amending your tax return from 2019, or you can actually, so that would go back and amend and put that $500,000 deduction, if you choose to take bonus depreciation, back in 2019, or you can file a Form 3115 change of accounting method and catch up that depreciation in 2020. So there you'll see, you'll just kind of take the remainder of that item that hasn't been depreciated yet, the $493,000 in 2020. So this just is one opportunity among many that you're going to see here where you have a choice, and you really need to dive into what is going to provide the better circumstances for you, what creates the better tax benefit. So what year will allow the deduction to probably offset higher effective tax rates is going to be crucial. And then otherwise, could the deduction possibly result in a net operating loss? And we're going to touch on that more and what we can do with those, but we can essentially carry those back 5 years now, possibly to a higher tax rate year two. So keep this in mind as we continue to discuss the options available to taxpayers regarding loss utilization here coming up. But overall, keep in mind that you have options with your qualified improvement property when placed in service and retroactively back to 1/1/18.
And Jenny, we had a quick question here. Yeah. If you own the building, would a roof replacement be qualified improvement property?
So a roof replacement would not be qualified improvement property, but that is something to take a look at. If it's commercial property, there are other options with potential Section 179 expensing that was back to the Tax Cuts and Jobs Act. That could be
right. And I'd like to add to that a little bit. I think with roofs, and we're going to touch on this a little bit later, but it's potential. You got to take a step back and look at what you're doing to the roof. If you're going down to the studs on your roof replacement, that's probably a structural improvement. And so some of that cost will unfortunately have to be taken over a longer period. But, if you're just doing a repair that maybe you do every 7 to 10 years, it's quite possible you have a good argument to have a repair there as well. So we'll talk about that a little bit more, and maybe we can circle back and touch on that at the end as well.
Perfect. Good point, Drew.
All right.
Oh, polling question time. All right, everybody, especially CPE users, let's talk on the first polling question that comes up for us here. Okay. All right, obviously top of mind. We'll talk on a little bit further on here, but has your business applied for the PPP loan forgiveness? So please select your appropriate answer. Maybe you've already got your information in and it's pending with either the bank or the SBA. You're waiting to complete it because you're waiting for the completion of your 24-week covered period. Maybe you did not obtain a PPP loan, or you're just basically in process of doing the application. So we'll give you a couple more seconds there to answer your question. All right.
Okay, you ready?
Perfect. Yeah, definitely pretty mixed results. It seems like I would say the majority, about 60%, are kind of in a limbo, either waiting for the end of your covered period or just kind of in process of doing your application, which I think is pretty typical. Thank you. All right, back to a few second chances with the CARES Act. This one I'm going to cover kind of quickly here. I don't know how applicable it was to too many taxpayers, but part of the CARES Act was removing the limitation for excess business losses. That was also part of the Tax Cuts and Jobs Act. So this is one of those items where, again, Congress was really just trying to look for opportunities to allow taxpayers to free up losses and create cash flow immediately. So previously, there was basically just no net business losses allowed from 2018 on in excess of $250,000 for single filers or $500,000 for joint filers. So that basically excess business loss wasn't there or available to create an NOL. It basically kind of was a different kind of loss carryover coming forward. So instead, now what they did was took that away for 2018 and 19, and basically you must go back and amend your 2018 tax return or 19 if you claimed or if you applied this excess loss limitation to that, and you will no longer have that carry forward going into 2020. So you do have to go back and take that loss against your other 2018 income. So unfortunately, there are a few circumstances where this might not actually be beneficial for the taxpayer. You know, for example, if utilization of that loss in 2018 will offset preferred rate, you know, capital gain type income versus offsetting ordinary income, it's still going to have to be applied back in that 2018 or 19 tax year. But in some circumstances, maybe this allows for a net operating loss that will be able to be carried back 5 years, as we'll talk on in a minute. So some taxpayers might find benefit, some won't, but the important thing is to ensure you're going back and amending that already filed 2018 or 2019 tax return if it had a loss limitation, as the IRS is not going to allow the carry forward of that loss. And once the statute of limitations are closed on that tax year, the benefit of the deduction would be lost permanently based on our current guidance on this matter.
Right. Okay. Well, then we're going to move forward to 163J, the interest expense limitations. I'm sure many of you have been familiar with this over the last couple of years. In 2017, with the Tax Cuts and Jobs Act, as part of the lever that they had to pull in order to get the law through the House and through the Senate, they had to kind of take things easy a little bit on the amount that people could deduct on equipment that they were already bonusing or 179ing. So they didn't want people doubling up on the same piece of equipment. They didn't want two deductions to be taken on it if applicable. So what they did at that time was they essentially said, all right, let's come back to the table. Let's look at your taxable income and let's add back a few things. And the biggest thing they usually add back is bonus. And so you come to a adjusted taxable income number, okay? And then from there, you see where your interest expense lies. And if it's over 30% of that adjusted taxable income number, then we couldn't take that deduction and it carried forward. So in the spring, what ended up happening with the CARES Act is that 30% got increased to 50%. So if you know that you got a limitation back in 18 and 19, it's a good time to go back and take a look at that and see if we can't increase our deduction. And it should be pretty easy change to make. Do a little amended tax return and then create an NOL possibly, or just have a lower taxable income number for a refund in that year. Probably though, what I kind of consider to be the biggest second chance is going forward. So we all know that in 2020, you know, certain businesses have been suffering. It hasn't been the best year for business. I mean, that's kind of it's kind of a conclusion everyone's drawn. But the great thing here is that in 2020, if we didn't have this second chance and we had a significant amount of interest expense and we didn't have any taxable income, we'd have a situation where we would not have any interest expense which we could deduct in 2020. But the positive thing here is that we can actually use the 2019 income numbers for purposes of computing our 2020 limit. And I think that's a real powerful tool that we can use for planning here in 2020 as we finish off our year. Another really good thing that some people have done already, but not many, but you can actually have flexibility on whether or not you want to be subject to this limitation at all. Okay. Now with this comes it comes a little bit of a give and take, which I'll explain here in a second. But you can, if you're an electing real property business, if you're a real estate professional, if you're a farmer, or if you run a grain operation, something like that, you can elect to withdraw from this election. And the reason being is just, it's just such a capital intensive market, and there's going to be a lot of, there's going to be a lot of interest being paid. And now, but the kicker here is that if you do make that election, you can't take bonus or 179 on the equipment that that you're leveraging in order to fund your business. So why is that important? Well, the reason it's important is at the time it was an irrevocable election. So that essentially forced you to take a slower depreciation number on that equipment. And the good thing in here is that another second chance is that we can actually now withdraw that election if you choose to go back and maybe take some accelerated depreciation on certain things that you maybe inadvertently caused yourself not to be able to take, or you can just keep things the way they are because you never know how things are going to go going forward, and you may need that deduction. So so that's kind of what I was wanting to say about 163J, but the biggest opportunity is definitely the fact that we can use the 2019 ATI in computing.
Sure, and one quick thing, Drew, partnering back with the qualified improvement property, that was, you may have made that decision to make the election as a, real property trader business because you realized you couldn't take bonus depreciation on your qualified improvement property anyways, so it wasn't as much of a trade-off. Now that you can, again, the ability to go back and maybe withdraw that election, you do now still have, and again, go back, take the bonus depreciation on that qualified improvement property and see if that's the better answer. So
absolutely, that's a very good point. Yeah, very good point. And then with all that, if you using qualified improvement property and 163J and certain other things that we're going to talk about today, the biggest tool that we really have in 2020 is we now have the ability to take our NOL. That's really no secret in our industry. I think that now that we have all these things that we can go back and look at, we can revisit certain things, and we can look, prospectively at a lot of things as well. Is that, in 2017, at the end of 17, it got to the point where we weren't able to take a carryback on our NOL. Not only that, we were able to, we could only take 80% a year, right? So what's occurred here is that we now can take a 5-year carryback in 18, 19, or 20. And what this effectively has done is that it's taken Trump era tax rates and it's effectively pushed that back into the Obama administration's tax policies. So, the reason that's important is because individuals back in 2013, 14, 15, 16, they were paying at the highest rate of 39.6%. Now that's down to 37. Big opportunities for C corporations. They were paying up to 35% tax back in 2013, 14. Now they have a flat 21% rate. So if you're looking at that rate difference and you have a loss, you're definitely going to want to take that loss against a higher rate in the past than stay put and take it against the current landscape. So that's a really good tool, but just keep in mind it's not always beneficial either. You want to take a look at it real close before you actually pull the trigger and decide to do it, because for certain C corps, so if you guys remember the brackets, I mean, the first $50,000 of losses was only taxed at 15%. Obviously, you don't want to go down that road if that's what you're looking at. And there's also other things we got to consider as well. You might have had a D-pad back in the day. I know it hasn't been that long, but a lot of us had D-pads back then. And the reason that was a valuable deduction is because you didn't have to spend money to get the D-pad. And so you don't want to carry back an NOL and then destroy that deduction, right? Also, there might be an R&D credit in there that you lose. You might lose your IRA deductions, your personal exemptions, and all these things that we need to kind of look at it globally before we decide to carry it back. But the great thing is too, if you decide not to carry it back, you can make an election to carry it forward. We don't know what rates are going to look like going forward right now. I know we had a debate last night on the election, but it looks like things are up in the air. We don't know how rates are going to look in 2 years. So maybe we want that NOL going forward. So, but just keep in mind, that in any of these attributes we're talking about can be used, and this NOL can be used as kind of at the end of the process to see, what real benefit we can get.
Mm-hmm.
And then kind of a side note too, this is a C corporation note. At the beginning of 2020, a lot of us set up our 2020 estimates based on a year that it turned out to be a lot different than it actually turned out to be. So I know I have clients that have been paying a lot of estimates. At least the first, second quarter estimates were large. They were looking at a COVID-free 2020, right? Well, now obviously that's different. There's going to be a lot of C corporations out there. This is only available to C corporations, but there's going to be a lot of excuse me, I got behind on the slides there. I'm going to go back up here. There we go. So there's going to be a lot of C corporations that are really going to be wanting that money back. They can file for a quick refund by filing on 4466. And once that form's filed, the IRS has 45 days to get you your money back. So it's just a little bit of a tool for you, okay, to use in order to get your money back early, especially if you don't think you're going to be paying as much tax come spring.
Nice opportunity that's just corporations then, right, Drew?
That's correct. That's
Yep.
correct. Okay. And so we'll move forward here a little bit and we're going to kind of switch gears out of the CARES Act a little bit here. And then we're just going to get into just some more general 2020 tax planning items. I know we've gotten a lot of questions about PPP loans, the deductibility of that. We're going to touch base a little bit on whether, how to accelerate deductions, how to accelerate income, ways to get income into the correct year. We're going to talk a little bit about the R&D credit and opportunity zones, things like that, other things that we can do in order to change the outlook for 2020 and going forward. And another one too, just to kind of mention to the group, is our 1031 exchanges. I know going forward, depending on how the election goes, I mean, it's quite possible that 1031 exchanges won't be around. So, if you have some property that you have some deferred gain in, not very high basis, it might be a good time to start talking to your accountant, talking to your attorney and your banker about maybe walking down the road of getting one of these done if it's something that's been on your mind anyway. But this kind of some issues we're going to talk about today. I'm going to go ahead and switch slides, and I think we're just going to dive right into it here.
Yep, I'm going to start into focusing on the 2020 income tax planning to some of these aspects, such as the PPP loan or some of the other incentives that were available. So again, focusing more on that income tax perspective of these programs. And so I know one of the really pressing issues and questions is in regards to the deductibility or taxability of the funds from the PPP loan program. So want to address that and really talk about the significant role that is really going to play and is playing in your 2020 income tax planning. So there's really two parts to the tax treatment of the PPP loan forgiveness. First, you have the actual forgiveness of the PPP loan, which would typically generate income for tax purposes when the SBA does forgive the loan. But Congress did include within the CARES Act that the loan forgiveness does not result in a taxable event. So when the PPP loan is forgiven by the SBA, this isn't a taxable event. However, after the CARES Act was passed, the IRS announced in Notice 2020-32 that the expenses incurred with the PPP loan funds would not be deductible, as these expenses were incurred in the connection with producing tax-exempt income. So no taxable income recognized on the forgiveness, but no deduction for the expenses paid or incurred on those PPP loan proceeds. And I know this is no small sum for a lot of taxpayers. So the IRS has not provided any specific guidance on the matter of timing as to what tax year this should impact, but based on what we know at this time, we think they're likely to consider these PPP expenses as non-deductible when they are incurred. So according to the IRS, the expenses incurred in 2020 would not be deductible in 2020, even though you might first be going through your PPP loan forgiveness process and not have it forgiven until 2021. So this might seem unfavorable and be looked at as an acceleration of taxable income into 2020. Obviously, some taxpayers might be concerned with tax rates being higher in 2021, though, depending on election results. So maybe that's a consolation in that this additional taxable income would hit sooner in 2020 and maybe be taxed at a lower tax rate. But basically, we'll talk on this a little bit more with potentially changing tax rates in a little bit, but this is an item that is still up for debate. We do have just recently resurrected in the last 2 days, the House Democrats are kind of trying to resurrect parts of that HEROES package again, and I know it's part of that. So just the idea that there is still some bipartisan support and work by Congress to actually, allow for these expenses to be deductible. But it is an item that the way things are written now, they're not deductible. And I think you want to plan for them to be non-deductible in 2020, but I think you want to run multiple scenarios so you really understand the difference since this is such a significant number.
Right.
So there are a few other ancillary items that the PPP expense non-deductibility could impact, and I put those at the bottom of this slide just to keep in mind if we continue in this environment, and really just need to keep top of mind that these expenses aren't deductible. Since the majority of those funds did need to be spent on payroll, the thing there is that payroll and wages oftentimes are utilized for other calculations for tax incentives in your tax return. So one I want to focus on in that list is going to be the wages that are factored into your R&D credit calculations. The R&D credit calculation is largely based on qualified salary and wage expenses. And so at this time, basically, if it's uncertain if the non-deductible treatment of these wages would result in them not being able to be considered qualified for the R&D credit. So therefore, it could reduce your R&D credit. We do have a more in-depth article exploring this on our Sikich Insights page, and it's something to consider as you're completing your PPP forgiveness application, because there could be ways to potentially make sure you're minimizing the amount of R&D qualified expenses that are included on that PPP application. Another aspect that would be beneficial potentially would be the impact of any non-deductible interest expense. So this might minimize your potential 163J limitation. So that's an item that maybe you do want to ensure is kind of included as part of that forgiveness, because it would have been limited with 163J anyways. And that way you can kind of make sure the right pool of expenses or the best combination and pool of expenses is there. So there's probably some things we can do there. But again, I completely understand that it's just frustrating because we don't have clear guidance. And this is such a considerable number, I know, for many taxpayers.
Hey, Jenny.
Yeah.
Let's say, and we got this question, and I've gotten it several times as well, is let's say, because the way the IRS seems to have the position on this is that if you reasonably expect your loan to be forgiven, then the expenses are non-deductible, right? So let's say something happens. Let's say maybe your loan's over $2 million and next year you get reviewed by the SBA. It doesn't go well. It turns out that the loan's not deductible, okay? I guess we have to file an amended return for 2020 in that case, if we want to get our deduction, correct?
That seems to be, what we're looking at, and that's where I think things might, really just time will tell how this plays out, and maybe it'll take a little bit of delay in holding off and filing that 2020 tax return if we think some more clarity is going to come on that issue. But that's kind of where we sit right now. I agree.
Okay. Another interesting issue, Jenny, that's come up recently too, to be mindful of is if we have a change in ownership, and you have a PPP loan that's outstanding that's not been forgiven, the SBA issued on August 24th that they're working on guidance on how to handle changes in ownership. And that right now, if you get a change in if you have a change in ownership, which would incur either a stock sale, asset sale, any kind of merger, they would deem that loan to be in default. So that's another thing that we're waiting on the SBA to give us some clarity on, because, you know, there's always transactions occurring and they usually move pretty quick. So that's
Sure.
another we're keeping an eye on as well.
Yeah, I think they just come full circle because, again, I know this is such a big number, and we've worked with clients and taxpayers as we go through each quarterly estimated tax period, right, and trying to discern what to include when you're trying to calculate those estimated payments. We just got through third quarter, and fourth quarter will be another one of those decision points. And really, what you kind of need to do if we don't have more guidance by then is to run the numbers both way. And then it's really a cash flow and business decision, right? Right now, if you underpay your estimated tax payments, the penalty there is potentially underpayment interest. So it's kind of that decision: are you willing to potentially pay the underpayment interest if you kind of kick the can down the road to the extension or due date of the tax return, or do you want to get those payments in to make sure you're covered? Right now we don't have any clarity or reprieve from the IRS on those quarterly estimated tax payments either. So it's really just a decision on whether you're willing to kind of wait and incur that underpayment interest if the IRS keeps that applied.
And with the R&D, and just to reiterate what you said, that if you have enough payroll to cover your forgiveness app, don't use that same payroll on your R&D calc, right?
Right. And that can be a more in-depth computation there. So that's just kind of a discussion starter. And I think if you're in that area where you do the R&D credit, we can talk further on how to maximize that or kind of keep your R&D credit maximized.
Sure. Okay.
All right, well, let's keep rolling for now and kind of keep getting through, again, a few other items from the CARES Act that I want to make sure, again, people or taxpayers take into consideration when you're trying to map out that 2020 taxable income and what the implications were for you. So one of those, again, maybe an alternative to getting the PPP loan was utilizing the employee retention credit. So the income tax consequences to that, you just want to remember, is that your deductions, again, will be reduced by the amount of the credit obtained. That's usually a typical fact pattern for credits obtained through the system. The other one would have been the payroll tax deferral that many might be utilizing. We did have the PPP Flexibility Act that allows you to utilize that kind of in conjunction with the PPP as well for a longer period of time. So one unique item there to just keep in mind is that keep in mind the timing of that deduction. So again, this is just something we're not really used to dealing with, but now if you're holding off on remitting those employer payroll taxes until the end of 2021 or 2022, now those may no longer be deductible in 2020. You need to think about how your accounting method works. So if you're a cash basis taxpayer, if they're not paid before the end of the year, they're not going to be a deduction against income taxes in 2020. Or if you're an accrual basis taxpayer, you might have a little bit more leeway with the reoccurring item exception in place to potentially defer those as long as September 15th, 2021, and still take that deduction in 2020. But the point is, now is the time to consider planning the timing of this payment in coordination with your income tax planning, and consider paying in advance of those 12/31 due dates if it could be beneficial from the income tax deduction standpoint. Again, this kind of assumes the more traditional tax planning of accelerating tax deductions. So if you think tax rates are going to rise, you may not mind having to wait to take these deductions in the future. The important takeaway is these special provisions in the CARES Act do have an income tax impact, and that should be considered when you're trying to estimate where your taxable income or loss is going to be for 2020.
Okay.
All right, we have our next polling question.
Number 2.
For everybody. So I just talked on the employer payroll tax deferral, but we also are going to talk just briefly on the employee payroll tax deferral that was more recently issued through executive order. So just let us know, did you elect to utilize and do the employee payroll tax deferral for your employees? Yes, no, or maybe you're still considering that. I'll give you a couple seconds to answer. Okay.
All right.
All
How did we
right.
know?
Well, we have about 90% reporting no, about 4 to 5% reporting yes, and the remainder still on the fence. So, Drew, why don't you take it away with that?
Well, I guess 90% sounds pretty similar to what I'm seeing. You know, the payroll tax deferral, it has been told to us through Notice 2020-65, as you can see in the bottom of our slide. It is optional for employers. There's no special opt-out provisions or anything like that. Jenny Andrews in our HR department does a real good job of making sure on this that, you know, we have the proper documentation in place in order to communicate to your employees what this is, and in order to, you know, just kind of solidify your documentation from an HR perspective. You know, if you need help with that, please let us know. But, you know, the biggest thing to tell employees if they're considering that, and what I tend to tell a lot of my individual clients as well, is that, okay, let's say you do need the money right now, and you're going to take an effective 6.2% pay raise, right? Because that's what you're basically going to have. But the kicker to this is that in January, through January and April, you're going to have to pay it back. And not only are you going to have to pay that 6.2 back that you already, you know, deferred, you're also going to have to pay your normal Social Security as well. So, logistically speaking, you've got a 12.4% pay cut right after Christmas and right before tax time. You know, for most employees, I don't think that they were going to want to take that kind of hit. I have seen clients choose to give them this option in the fall and then also give them a bonus after year end and just put that on their W-2 as taxable wages. That's one nice thing that you can do if we've got, you know, a situation where we have certain employees that may not be having the best of luck. Maybe it's a tough industry, tough area, but you know, from what we're seeing in our polling question, it doesn't seem like there's a whole lot of traction for this executive order, which came out in August. So I'm going to move to the next slide here and talk a little more about planning. It's probably about the simplest slide as you can get, but it's really, it really is what we try to do here. You know, there's a lot of things to look at, but when it comes down to it, do we need to increase sales or reduce expenses? And when looking at that, we look at the overall business plan of the business, right? So, and we all know now most successful businesses, they don't let taxes drive the bus, right? Taxes are a part of the plan, but it's not the whole thing. You know, I know 2020 has been tough. There's been revenue loss for a lot of our businesses. Some businesses have been doing great. Others have not done so well. There's been a lot of supply chain disruption, as we all know, back in the spring especially. We've had furloughs and staffing reductions, and there's just been a lot of uncertainty. So when we look at that, we just got to take a glance and say, all right, well, how do we make more money? How do we spend less and make more? I mean, that's what we all want to do in business. Are we set up from a technology standpoint to work remote if we have to go down that road again? Was that something that negatively impacted your business? I know over here with our firm, we've done a lot of projects recently, taking businesses and making sure that they can effectively go remote. Okay. You know, are we using our Salesforce product in order to effectively look after prospects for business development purposes? You know, is our ERP system set up effectively? And, you know, so that's all ways, you know, though you're making an investment early, that's all a way that things that you can do in order to make sure that your business is running smooth. You know, how's your advertising? Are we using more of a shotgun approach, or do we need to bring in some consultants and make sure that we're a little bit more specific in what we're trying to achieve? You know, because things just aren't as easy as they were 2 years ago. And one thing that we like to do with our clients as well, at least on a biannual basis, is have strategic planning meetings. You know, things change quick. You don't want to just meet with us, you know, in the spring. Definitely don't, you know, definitely not in the spring. You want to meet with us before year end, right? At least once, but try to do it twice a year, maybe even quarterly. Bring your attorney in on it, you know, and just take a look at your overall plan and see how we can get this done. Because right now, the biggest impacts and the things that we need to look at are you know, one of the biggest is how are Biden's tax proposals going to affect our company? You know, we have an election that could result in a material change in the tax law, and it could happen. Probably won't happen next year, but it'll probably you know, if we have a blue wave go through the Senate,
then we're going to have a change in the tax law probably at the end of next year. And that's something to keep in mind. We need to watch the Senate closely. If it looks like the balance of power shifts in the Senate, then we need to start thinking about things. You know, if that occurs, we got to realize the top rate is going to increase to 39.6%. Okay. If you have a liquidity event that's occurring, if you have some succession planning you're doing, you know, if your earning is more than $1 million, which could easily happen to someone who's selling their business or just has a great business, then, you know, your capital gains rates are going away. Okay, they won't be there anymore. Your qualified dividends are going away. That's not going to be taxed at capital gain rates anymore. You know, your C corporate rate is going to increase to 28%. At least that's what they're saying now. And then you know, if things like credits, you know, are going to be a little bit more prevalent. I mean, that's one thing. Anytime there's a change, we lose some things and we gain others. I think Biden's talking about the breakthrough technologies, manufacturing tax credit, and things like that. So, you know, these are all things we need to think about actively right now, because you know, things could change materially come November, and so we'll be keeping a close eye on that. But one thing slide that I did want to share with the group, and I want everyone to take a look at this, is what we're currently looking at now for 2020. And I want to bring the QBI effect into play, because we cannot forget how powerful the qualified business income deduction is. And if we look at the married, filed, and jointly brackets, and let's just pick that 24% bracket right there in the middle, okay? And you see, we got $327,000 of income we're working with here. And if you make 327, your marginal rate with the QBI is 19.2%. And that is a powerful rate, because you can do a lot of things to get you below that 327 and not have to dive down to the zero income level and still maintain a really good tax rate for your business. Okay, so 19.2 is very good. All right, so just keep in mind, you don't have to, you know, if you buy a large piece of equipment, you don't have to run it into a loss. You might want to take advantage of that 19.2% rate. Okay, and if rates go up next year or 2 years from now, then you'll have a large piece of equipment that you can deduct against the higher rate. I mean, equipment's usually a common thing we talk about, but just keep these rates in mind, because, you know, right now for business, we have a very positive tax structure. Okay, so I'm going to move on to the next. And Jenny, are you going to take the R&D credit here?
Yeah, let me touch on that and then talk on a little bit of those acceleration, deceleration of income and deductions items. First, one quick plug here for the R&D credit, though. I always like to bring up, and especially now, it's just a really important time to evaluate or reevaluate your R&D tax credit benefits. You know, whether you've been claiming these in the past or have never done so. A few key things to keep in mind: taxpayers are eligible for R&D credits on the development of new or improved processes and techniques that you might be using. So one significant key is that these developments only need to be new to you and not new to the world. That's something that I really try to stress to clients. So I know just a lot of businesses have potentially undertaken some really significant R&D activities in response to COVID-19. You know, several companies have had to alter and adapt your processes in order to essentially, you know, maintain your operations. You're forced to quickly enhance your IT infrastructure to increase your mobile or e-commerce functionality or improve remote work capabilities. So there's a lot of time and expense consumed during development and research phases of implementing these changes that could likely be captured as part of an R&D tax credit. In addition, I know many manufacturing companies might have done a complete pivot from their normal production activities in order to aid in the supply of essential PP&E. So the time and resources used to create new manufacturing processes, test new equipment, or improve current efficiencies can lead to enhanced R&D credit. So I really want you to make sure you're taking a closer look at that, diving into your projects, and, you know, potentially doing an in-depth study on that this year to really maximize that credit. Okay. All right. But other than that, diving into some of those, again, tax planning, income deferral, deduction acceleration, I'm going to cover those items, which we would typically see in maybe flat or declining tax rate environments. But you'd also want to think about if you want to maximize a loss for carryback purposes to tax years that maybe had a higher income tax rate. So just touching on a few items there, your normal, obviously paying expenses to get them to be deductible in 2020 is something important to pay attention to at the end of the tax year, depending on if you're cash basis or accrual basis. Drew touched a lot just now on the qualified business income deduction, and this could kind of be in either camp of income acceleration or deferral. But I think the main point here is that this is a deduction that is going to be with us temporarily, regardless. You know, right now it's scheduled to go away in 2026, but we might lose it sooner, or certain taxpayers could. So the big thing is to, you know, for permanent savings from this, you really want to make sure you're maximizing that, and whether that be actually an income acceleration event to make sure you're being able to apply that 20% deduction to the income. But keep in mind some of the limitations that come with QBI. It is limited to 50% of wages. So that is one particular item that you want to make sure you're paying attention to, is are your W-2 wages, you know, maximized or enough to make sure you're getting all that you can out of that QBI. So that's one thing to definitely take a look at before the end of the year. Drew touched on before too, 1031 like-kind exchanges. Those are still available to taxpayers right now for the like-kind exchange of real estate. And so, as Drew mentioned, that's something to really take a look at. It could be going away, but it's something to plan for carefully if you're looking at deferring the tax on the gain, you know, while that's still available. But again, something to consider in regards to maybe now is no longer the time to defer that gain, and maybe it takes some strong consideration to look at recognizing that gain at the low tax rate environment that we do have right now.
Great.
And next, I wanted to talk on charitable contributions, since we did have some changes with that as well. And that can be an item to lower your taxable income right now or accelerate some deductions. Just some of those changes to summarize were that corporations there used to be a limitation where you could only deduct up to 10% of your taxable income as charitable donations, and that is increased to 25% here for 2020. Again, these are just for 2020. Individuals, there's several different categories in place here, but there was always some type of limitation that your charitable contributions couldn't exceed of your adjusted gross income. Mostly, you know, a 60% limitation applied in most instances. But for 2020, individuals can actually deduct up to 100% of their adjusted gross income with charitable donations. Now that extra, moving from the 60 to 40%, there are some specific qualifications on that. It does have to be a cash donation directly to a public charity. So putting it into your donor advised funds or donating stock doesn't necessarily work for that, but you can, you know, stack that on top of other donations that you've done to use that cash donation to a qualified public charity to get to the full 100% offset of your income. Something to think about. It's a tool you have available, but again, you can still actually elect to not utilize that higher limitation. You can elect to use that standard prior limitation and basically create a carryover of your charitable donation to 2021. So that's something important to map out and maybe a tax return filing decision, because maybe you don't want to utilize those deductions against lower tax rates. Maybe you want that to carry forward to 2021, where it potentially could be used against higher rate income. So those are a few new items with charitable contributions. And then otherwise, again, traditional tax planning concepts of accelerating deductions. Want to remind you of those opportunities with depreciation. Obviously, bonus depreciation, Section 179 expensing, looking at your qualified improvement property that might be eligible for 179 or bonus. We haven't talked on this one in a while, but looking at your de minimis safe harbor election, you know, there is actually a de minimis amount now applicable from the IRS, and seeing what kind of fixed asset capitalization policy you have in place. That can be up to $2,500 or $5,000 for some taxpayers. So just kind of making sure you're peeling away and expensing those smaller items can really add up in some years. Utilizing a cost segregation study if you have a bigger building project put in service, that can definitely help you accelerate depreciation deductions. And as Drew mentioned before, oftentimes with roof projects, a partial disposition, this applies to a lot of different scenarios. But again, if you're doing some type of renovation or replacement, again, the cost segregation study can help in that, but taking a look at, while you're not only putting a new asset in service, what old part of that asset can you dispose of for a write-off? So
Yeah,
again,
Jenny, I've found when I'm looking at a potential client and I get looking at the depreciation schedule, I find it can be very common to find 2 or 3 roofs on the depreciation schedule.
right,
And that's a common thing because anytime someone's working on the roof, they just throw it right on there. And with a partial disposition, that means if you put on a new roof, well, you got to take your old off so that you can dispose of that old roof and deduct whatever basis is left in there at that time. So
sure.
it's
And I
very,
know we had a question here about, should you be deferring expenses actually to 2021 with a potential increase in tax rates? And I'm going to let Drew here talk on that side of the coin. There's just a lot of options that are important to be mapped out right now. Whether cash flow is really important to you and you can create losses and carry those back to prior years, either with higher tax rates or just to produce cash flow right now, that would be really important. To accelerate deductions. Drew here will talk on maybe, again, reasons in an environment if we're going to potentially be looking at increased tax rates, what should you be doing if you're really focused on deferring items potentially or deductions to those future years when they'll go to a higher use.
yeah. And so here's some, we got about 3 minutes left here. And so we're going to kind of move through some of these slides a little quicker because we do want to leave some time for you guys to ask us questions. When it comes to what we're going to do as far as accelerating deductions into this year or deferring them into next year, first we got to see what we think our business is going to look like in 2021. Do you think we're going to have a bigger year in 2021? For our contractors, we know our backlog, we know what kind of bids are out there and things like that. So think of that first. And then when it comes down to the political climate, I think we just got to wait till November. No one really can tell. No one has a crystal ball right now. So, if we get into November and we have a situation where we look like we need to start making some changes, then we'll do that when that time comes. But for 2021, I would imagine we're going to be keeping our same tax structure at least through 2021, even if there is a complete change in Capitol Hill. But I wanted to just kind of put this in the slides. Here's some ideas in order to actually increase income should we need to. I'm not going to just read all these off. I know a real powerful one though is electing out of the installment method, or even just having someone pay off their installment note this year. That's a good way to get capital gains into the current year. So if you got an installment note that you're either getting ready to sign or getting ready to do, that's something to consider. Here's some more ideas as well. Roth IRA conversions are a big deal right now. The market's up, rates are low. It's a good thing to do should you choose. Okay, and Jenny's mentioned this earlier as well. You can take your IRA distribution if you need it. So I know you don't have to, but it is a tool that you can use. Okay. I think we had
a quick example that really just kind of drives home some of those points we've just talked on that decision-making process. So, in this case, very simplistically, if you have 100% bonus depreciation and you have $1 million of property put in service here in 2020, you can look at the 2 different options available to you in the simplistic example where, this filer, a joint filer, had other, wage income and business income. And essentially, if they take that $1 million of bonus depreciation, it's going to create a $300,000 carryback. And that would go back to 2015. And maybe they were in the 39.6% tax bracket at that time. And so if you go to the next slide there, Drew, it kind of weighs out the different options in regards to creating that net operating loss that can be carried back to a time when you were in a higher tax rate. So not only does it save you the tax in 2020, but also clawing that money back from prior years. This simplistic example goes through about 230,000. And then, looking at the foregoing the bonus depreciation utilization. And, And that's the other side of the schedule there that shows, allowing that taxable income to hit in 2020, but then allowing those deductions on that $1 million of property to carry forward into the next 8 years. And if you are going to be in, maybe a 30 and then increased it to 40% in years to come, using that slowly over those higher tax brackets in the future, even with present valuing that back, can be a really valuable savings. So just the dollar comparisons there are looking at, maybe you really need the cash today. So $230,000 of cash savings today might be really important versus, carrying forward those deductions when they could result in a higher amount, even present valued. All right, let's get to our last polling question here quick while we still have everybody on. Thanks for bearing with us here. So how far along in your business, in your tax planning process are you? Have you started those discussions? Have you been having those along the way throughout the year? Do you need to get kind of started on that in your process right now? Just give us your opinion, and that will be our last polling question for today. So thanks for bearing with us there. And then we're just going to have a few more wrap-up comments, and then we are going to have the Q&A here for the next 15 minutes that hopefully you're willing to stay on the line for.
Great. How are we looking on that question, Jenny?
Yeah, no, about a little over half of you have just started, which I think is appropriate right now. Really, as we're going through Q3, it really got things top of mind, and now is when things are going to play out through the rest of the year is to really hone in on some of these things. So, to recap some of those planning strategies to keep in mind, you just want to be able to evaluate and review your depreciation schedules, evaluate what tax rates you were in the prior 5 tax years, work on projecting your 2020 tax income or loss, and looking at if you want to try and increase that loss. Does your current tax accounting method fit your needs? There are still some opportunities yet available to change your method of accounting from the Tax Cuts and Jobs Act for those taxpayers that are under 25 million in gross receipts, inflation adjusted. And most importantly, it's just, to map these items out, but realize that they may change significantly as you're going to be, and you're going to need to be flexible and have to make some difficult cash flow and tax payment decisions between now and April 15th with less than perfect information, as you can see. The fact that Congress could still change that result for those expenses for the PPP would be a huge swing for many of you. So I'd encourage you to actually map out both scenarios and really start mapping out what this is going to look like for you for 2020.
Yeah, that's a very good point, Jenny. And just a couple things left. Here at Sikich, we do much more than just tax planning. We're a professional services firm that is designed to get you the most value for the dollars you spend with us. These are all things that we do in addition to tax planning, and these are things that I've been involved with as well that have become very important just with COVID this year. Insurance, business interruption insurance is a big one with Mary O'Connor. And another one is that, you get a decrease in the fair market value of your property. It might be a good year for a tax appeal too. I know commercial property hasn't been holding its value like a lot of people would wish, but that at least is a couple ideas that you can do and things that you can go down to maybe lessen the burden for you. We do a lot of technology advising. We help with cybersecurity. We have a transaction advisory team that will help you through your mergers and acquisitions. So just keep us in mind as you go through significant events, and use our firm. We're a very good firm and very proud to be part of this firm. So that being said, Jenny, thanks for doing this with me. I enjoyed working with you today, and I think it's time for some questions.
Yeah, you too, definitely. We had a few questions that I don't think we were able to address as things were rolling through here. So while we're waiting, if anybody has questions, certainly again, put those in the chat feature. So going back a little bit here, I know there was a question in regards to, again, on that, what to do with your, potentially non-deductibility of expenses related to the PPP loan, especially if you're a fiscal year filer. I know that's putting a lot of taxpayers in that fiscal year situation in a tight spot. But really the point there, I think, is going to be, as a C corporation, it's not as difficult to amend a tax return later on, but if you can, I'd hold off, having extended that tax return, wait until that extension due date. I would hope in the next, months to come before the end of the year, and then maybe right after the beginning of the year, we would have some action on this if we're going to see it. And so I guess I'd encourage you to plan for the non-deductibility in your extension payments, but then hold off on filing that tax return if you can, otherwise knowing you may have to amend it.
Yeah, I actually just looked at my first fiscal year C Corp, and this one in particular, they had a loss anyway, so we just got it over with. We just went ahead and made it non-deductible, and we still maintain their loss. So in that situation, you might want to just accelerate it and get it done. But I think Jenny makes a great point. I think extending would be a good idea this year.
Sure.
We got another question here. After the 24-week period, is there a time limit on how long you have to submit your forgiveness request? I don't think we answered that one yet. Jenny, you want to answer that one, or I can answer it?
No, go ahead.
10 months. You got 10 months. So.
Yeah, and I think on that timing aspect, like I said, there's still a lot of talk on that, and probably a lot of talk, information that we'll be putting out too. I think some things to think about right now is, one, to first know your bank's status and accepting that application. I think from what I've seen, banks are all in different scenarios right now in regards to their readiness and willingness to accept the forgiveness application even and go through it. So first, check with them. Second, really try to ensure that you're not going to be limiting your forgiveness due to FTE or salary reductions, if at all possible. So there are now several safe harbors that you might be able to qualify for. So
Absolutely.
those should be examined, as well as the timing of when your FTE and salary will be considered restored, if they will be. So that's something to look at. In some of those different proposals that were going through Congress earlier this year that weren't enacted, I know there was talk that they were going to potentially eliminate or extremely reduce the reporting requirements for forgiveness on loans under $150,000. So, if your PPP is under $150,000, you might want to consider just holding off, because if that would become part of these future bills in the next couple months, you might just have a box to check and be done, and that might be worthwhile.
Right.
So consider, I think, waiting for more guidance in some circumstances. You don't have to wait until December 31st technically, or anything like that, but I think you just want to go through what makes sense for your purposes to ensure you're maximizing that forgiveness.
And for purposes of the R&D credit, we did get a question about, and I think hopefully I'm reading this correctly, if we have discretion over what payroll we use where, can we pick certain payroll off of our payroll ledger, use it for the forgiveness calc, and then pick other payroll, use it for the R&D? The answer to that is yes, but you got to make sure that the payroll you use for R&D is actually an employee that is being paid in order to perform research and development activities. That's the only, for the PPP shouldn't be your concern as much as it is that you don't want to use employees on your PPP forgiveness note in order to, that qualify for the R&D credit. If you have one or two employees that just do R&D work for your business, then that's when you use that payroll for the credit.
If you have that flexibility, and that's, it's not certain, but that's just kind of a way to help hopefully maximize that in case we'd run into, the scenario ultimately where the IRS is going to comment that they wouldn't be,
Sure.
qualified there.
So,
Similar related question on QBI, the qualified business income deduction. Do you have to reduce the salary portion or, that W-2 limitation, considering if those same expenses were used for the PPP loan and not deductible? That's also one that's kind of a gray area. I probably feel a little bit better about that one, because when you look at the qualified business income deduction and the wages limitation, it is driven by W-2 wages specifically. And so, the non-deductibility of PPP proceeds shouldn't affect your W-2 reporting. So I would hope this isn't going to affect your QBI, but that is something talked about among practitioners, that it potentially is there, I guess.
And part of the intent of that deduction as well, Jenny, was to encourage businesses to hire employees. They want to give deductions to businesses that actively hire employees, right? So, and like you said, the limitation is based on W-2 wages, and even if you're using it for PPP, W-2 wages probably won't change at all. So, Looks like we got one here. Let's see here. I'm going to read it off my chat. If a business has a PPP loan and is now involved in an asset sale of the business, Drew mentioned the SBA would consider the loan in default. I assume the loan would need to be paid in full at closing. I'm correct. Am I correct to assume that once repaid, the seller would lose the ability to have it forgiven? Yeah. So this is we got this from a bank that had been working with the SBA through the transaction. The bank that I was working with, that when I got the answer, they reached out to the SBA and that was their answer to the bank. Now, that being said, we're working with our attorneys in order to get certain agreements in place that the bank would not hold our client liable for a default. It's up to the bank in order to enforce the default. So what they put in there is a forbearance clause in the agreement in order for the bank to say, look, we're not going to come after your money if the SBA considers it in default. Don't know how the mechanisms of that are going to work because this is very fresh, very new. But in the case I'm looking at right now, yeah, I mean, the loan could need to be paid in full at closing, but I don't think it's necessarily a necessity. Right now, there could be certain things in place in order to true up the proceeds after the loan is forgiven. You could do an escrow agreement, or you could see if you can get a forbearance clause in your agreement in order to get, a handshake agreement with the bank saying the bank won't come and take it should that occur. Because most cases here, as long as it's not a related party, I mean, it's an arm's length transaction. It's just at a bad time, and I'm sure the SBA will hopefully come out with some guidance on that very quick. Hopefully that answered the question here.
All right. I don't know, anything else come to mind? I'm not seeing other questions flowing in here, but certainly want to thank everybody for their time this morning and invite you to continue to have these conversations with us and your other advisors throughout the rest of the year. And we will continue to keep you up to date. Please follow our updates on our Sikich Insights, our website. We certainly will continue to provide timely content, as maybe we'll have some more legislation here before the end of the year. We'll see if they're able to reach some compromises.
Sure. All right. Well, thank you, everybody. It's been a pleasure. And I think this will be it. So thanks again. Let's see if I guess I'll show my face again to everybody. And then I think I just kind of turn it off. Right. Thanks, everybody.
All right. Take care. Have a good day, everyone. Thank you.
Bye-bye.